Hi everyone, in this week's lecture we will cover additional topics on interest rates. So today's agenda is the following. First, we will review a bit of last week's topics on the term structure of interest rates. Second, I will explain the difference between nominal and real interest rates, which is something I touched upon last week. Number three, I will explain how we are going to understand interest rate risk. Namely, we're going to try to understand how changes in interest rates can impact bond prices. And lastly, we're going to talk about no arbitrage pricing in the context of bonds. Specifically, we're going to try to explain how, or try to derive the term structure of interest rates with actual bonds being traded on the open market by constructing so-called synthetic portfolios of bonds. And we're going to use the law of one price in order to do so. All right, so first things first, let's review a bit of what we learned last week. So last week we learned how to use the term structure of interest rates to basically match maturity with specific cash flows and discount those cash flows back to time zero in order to derive a price or present value. So long as the cash flow is risk-free or riskless, we can use the term structure of interest rates to discount those cash flows back to time zero. Second, we also talked about so-called riskless bond yields as determined by bond prices. Specifically, we discussed the topic of treasury bonds, right? And how they have semi-annual coupon payments. They're backed in full faith by the US government, and therefore there's a negative relationship between bond prices and bond yields. All right, so we should have a good idea how bond prices are determined, namely about their investor expectations on future economic growth, how the government or central bank are going to change its policy in the future, and also probably most importantly is investor expectations about future inflation. And so we're going to start our learning objective today by discussing inflation risk and how we can actually decompose the so-called nominal yields or nominal interest rates into different things, namely into two primary components of a real interest rate and a inflation rate. So our learning objectives today is to begin by understanding what inflation is and how we can actually extract inflation from nominal interest rates and ultimately give us what we call the real interest rate, which is supposed to represent interest earned after accounting for changes in prices, okay, over time. So I'm going to give you basically two ways to explain what inflation is. One is kind of abstract. First, inflation is supposed to represent, so I'm going to write what is inflation. Inflation is going to represent how fast average prices increase over time. So this could be asset prices, that could be commodity prices, consumption prices, everything. And this will impact how fast inflation will grow over time. Okay, so that's kind of the abstract definition of what inflation is. To give you a more tangible explanation, we're going to think of inflation as changes in what's called consumer price index. So CPI is going to represent our inflation or price levels, overall price levels. So CPI is equal to consumer price index. Every country has its own CPI. China has its own CPI. Hong Kong has its own CPI. The US has its own CPI. And CPI is essentially a basket of goods and services that's consumed by the typical individual or citizen within a city, country, whatever. Okay? So you should think of the CPI as the average price of basket of goods and services consumed by a household or individual. Okay, average household. Okay, and so inflation basically is the percent change. I'm going to use percent symbol and then the delta Greek symbol to represent change in CPI. That's what we're going to work with essentially in this course, just so we're going to be more practical rather than abstract. All right, so again, big idea. The reason why inflation is important is because inflation is going to impact our purchasing power of real goods and services over time. And so even though we're earning interest on a specific asset or deposit at a bank, those interests could be eaten away by increase in costs of living or the fact that there's more money circulating in the system. Okay, so think of two ways in which inflation can occur. One is when we have a short supply of goods and services. In that case, you can imagine that price levels will rise because demand will stay the same, but supply is cut, so prices are going to be elevated. Conversely, you can think of another way in which inflation can increase through increases in the money supply. So if the government decides to print more money, such as to pay off their own debt, then you're going to have what's called hyperinflation, in which the value of the currency becomes extremely weak, and you have to have more dollars to buy the same amount of goods, since everybody has more money to begin with. All right, so that's inflation. We're going to talk about an example in which we should try to account for possible inflation when it comes to retirement planning. Second objective we're going to talk about today is interest rate risk. So interest rate risk, specifically, we're going to define it in terms of how the price of bonds will change in response to changes in the interest rate. Okay, so think of delta P, where P is the price of a bond, with respect to a change in interest rate. So maybe delta R. So R I'm going to use for my nominal interest rates, and P is my bond price, okay, variable. And lastly, we're going to talk about no arbitrage bond pricing. So we're going to think about how to convert coupon bonds to zero coupon bonds. So as you learned from last week, coupon bonds means there are intermittent payments between issuance of the debt to its maturity. And a zero coupon bond is one that only has one final bullet payment in which you get the principal back in which you lent out, and also a specific interest, right? We can construct such a zero coupon bond from coupon bonds by formulating or constructing a portfolio of bonds, okay, as you will see. In that sense, we can actually derive a price for this hypothetical zero coupon bond and therefore get a bond yield and therefore ultimately get the term structure of interest rates that we want. All right, so that is our task today. So let's move on to our first item, which is nominal and real interest rates. Okay, so I start our discussion on inflation and nominal and real interest rates by first just talking about an example in which we only have one good in the entire economy, okay, apples. Suppose that there is only one thing you ever buy or anyone else in the economy ever buys, and that's apples. Apples currently cost $1 each. You can invest in a savings account alternatively, which is your opportunity cost of 10%. And I posed the question, does this mean that investing today, you'll be able to buy 10% more apples in the future? So if you've been listening carefully for the last 10 minutes, you'll realize that obviously in general, probably no, right? Because purchasing power will likely change if inflation or price level changes over time. So you can argue it will stay. You can probably buy 10% more apple in the future if all things equal, nothing changes. But in reality, everything is constantly changing. And as you can imagine, in recent events in which we have countries printing massive amounts of money to make credit more available to those who need it, you're going to expect future inflation. And in those cases, your purchasing power is going to decrease. So in general, I'm going to write it down. General. No. The reason is because purchasing power changes if inflation changes. All right, and as I mentioned already, inflation can change for multiple reasons. I'm just going to give you two main reasons, okay? So why does it change? The reason is perhaps the supply of apples change, right? You can think of a decrease in the supply of apples, but if demand remains the same, then you're going to think, oh, maybe these businesses that sell apples have more pricing power, and therefore they can elevate prices as a result. And second, you can think of the supply of currency. So if there are more dollars floating around, everybody has wages increasing, and you can think, okay, assuming that you can't import and export apples, okay? In the case in which you can't do that, then if there's more money in the system, then everybody is we're essentially just adding zeros to everybody's bank accounts, then price levels will obviously rise. Supply of dollars changes, and if you have more supply of currency, then you're obviously going to have more prices. Of course, we're assuming that no exports or imports, right? The reason I state this is because, well, if price levels increase within a country, you can always import cheaper goods elsewhere, and then there's an equilibrium. But for simplicity, suppose that we're in a closed economy and the government decides to print more money, then everybody just has more money and price levels obviously will rise. All right, so let's dig a little bit deeper and add some numbers to these to this exercise. All right, so suppose that you have $100 today, and you either spend that money on apples today at the price of $1 each, or you can invest it in a savings account that earns 10%. The price of apples is going to go up to 5% during the year, suppose. And the question I pose, how many apples can you buy today versus next year? All right, so let's work out this simple exercise just to see how our purchasing power changes given these opportunity costs and also the expected inflation over time. So I'm going to answer this question with a table. To make things clear, so suppose I'm going to look at the money available today that I have, and I'm going to compare that with the price of apples. So today versus in 1 year, right? So if I hold on to cash today and I deposit in the bank account to earn interest of 10%, so that's my next best investment alternative, then I can get $110 for investing in $100. The price of apples, on the other hand, also has some sort of returns in dollar form. So if you hold on to apples, it's going to cost you $1 today, right? But if you don't sell it and suppose it doesn't depreciate in value and so forth in 1 year, then it's going to be worth $1.05. All right. So that's a 5% increase in prices, price levels, assuming that apples is the only good being consumed and traded in this economy. So our purchasing power, so I'm going to write can buy, today would be 100 apples. But if I waited a year, my purchasing power would be 105 apples roughly, right? There's a rounding because we're actually taking $100 times 1 plus 10% divided by 1.05 per apple. right? And this should give you a number around 104. 104.76, which is roughly 105 apples. All right, so what is our conclusion here from this exercise? The conclusion here is that you can only buy 5% more apples, right? Not 110% more apples, because the price of the good has increased. So you are only 5% better off and not 10%. In other words, which is our final most important conclusion, is that your real interest rate is approximately 5%, not 10%. So in this context, the real interest rate is simply the nominal interest rate after we adjust it for inflation, or the change in prices over time. All right, so we can formalize this with an equation. So we can think of the growth of purchasing power as taking the growth in money, which is our opportunity cost, and discounting it by the inflation rate. Okay, so in this second paragraph, I have an equation for you. It states that the growth in purchasing power is equal to the growth in money, which is the interest rate, divided by the growth in prices, which is inflation. So 1 plus R divided by 1 plus I. And that's going to equal to 1 plus RR. So RR is our representation of the real interest rate. Okay. So strictly speaking, RR represents the nominal interest rate after adjusting for price increases, or if you want to think of it more abstractly or economically, using economic intuition, it's supposed to represent your purchasing power of goods and services, tangible goods and services, not just in dollar form. All right, so one way to write this is to subtract 1 from both sides of this expression, and we should arrive at this equation here. However, this approximation requires a little bit of algebra, which I don't think is too hard. All you need to do is multiply both sides by 1 plus I. So let me just work that out with you. So RR times 1 plus I is equal to R minus I. That leads to RR equal to R minus I minus RR I. Okay. And then realize that multiplying two numbers that are close to 0 will get you something really small. And so we can just simply assume it's approximately 0. And so that's how we get this approximation. But we can actually get a precise equality if we are talking about log rates or continuously compounded interest rates. So if we were to rewrite this expression a little bit more, complexity using continuous compounding, we can think of the continuous compounded the real interest rate is equal to the continuous compounding of the nominal interest rate and discounting it by the continuous compounding inflation rate. Let's take the natural log on both sides, and we get ERR equal to log ER minus log EI. And then realize that log of E is simply, log of E just goes away, right? So we should get we should just get RR equals to R minus I, okay? So that's how we get strict equality if we were talking about continuous compounding interest rates as opposed to simple periodic discrete compounding. All right, so let's go through an example in which we have to consider inflation in the context of retirement savings. So on slide 10, I give you this example where you are 30 years old and you plan on retiring at age 65. Okay, so according to insurance companies and their analysts, they think that based on your habits and your other characteristics, you will live until the age of 90. All right, so let's do some planning for your retirement. So once you reach the age of 65, your goal is to maintain a spending of 50,000 US dollars in real terms for each year until 90 years old. So real terms here really actually means that you should be able to spend $50,000 in today's dollars, or when you are age 30. Okay, so real terms really just means that those dollars should have the same purchasing power as they would have had or should have when you are age 30 and you started planning for retirement. Okay, so let me just emphasize that when we think about real terms, we're actually just thinking about purchasing power in today's dollars. Okay, so let's think about what this retirement savings plan looks like visually using a timeline. So for this first bullet point, we stated that we're going to retire at age 65. So I'm going to start at age 64, and then at age 65 I will retire, and then age 66 I will receive 50K. Okay, but in real terms, okay, as of age 30. And when I'm 67, I will receive 50K as well, and until my death of 90. Okay, which I will also receive 50K, and then before I'm 91, I'm dead. Okay, so that's the goal. Now we need to actually create income for ourselves in order to afford such a retirement savings plan. So the second bullet states that our starting salary is going to, at the end of this year, will be $75K, $75,000 in nominal terms. And based on our productivity, we're going to be able to grow this $75K by 3% annually until we retire at age 65. Throughout this period, from age 30 to age 65, we're going to have a nominal interest rate of 7.1%. So we're just assuming there's a flat term structure, and that means that the interest rate is going to be fixed at 7.1% every period. The inflation rate also is assumed to be 2% every period as well. Okay, so you can think of this as an average. You can think of these two numbers as averages over our lifetime, which is I mean, for our sake, it's not unreasonable. So the question that's being posed to you is, what fraction of your salary should you save each year in order to achieve your goal of being able to afford such a payment until from age 66 to all the way to age 90, or to our deaths? Okay, so again, to re-emphasize what our cash flow to ourselves, or income to ourselves, looks like in a timeline, let's just draw it out. So our timeline looks like the following. We are age 30 today, but next year we will make 75K nominal. Okay, age 32, I will make 75K, but it's going to increase at a 3% per annum rate, right? And we're going to keep earning 3% every year, so it's compounded all the way up until age 65, which we will earn 75 times 1 plus 3% times 34, right? 34 times compounded. All right, so using the variables that I identified last week, or the weeks before, I'm just going to use those variables to represent inflation, nominal interest rate and real interest rate, or growth rate. So G here is going to be 3%. Remember, this is the G corresponding to those growing annuity formulas, right? And R is going to be our nominal interest rate of 7.1%, and I is going to indicate our inflation rate of 2%. All right, so the idea here is that we want to accumulate a fixed amount every period of our income stream all the way up to age 65 in order to afford the price or the payment of this package, to buy this package in which we will earn $50,000 every year from age 65 to age 90. So big picture wise, what we really want to do is be able to calculate the present value of this package, my retirement package, and compare that to the present value of my income stream at the time I am age 30, right? Or our times 0. So our times 0 is when we are of the age 30. All right, so the next slide gives you some hints on how to approach this question. And so let me just read this out loud, and then I'll go through every step to explain how we derive a solution. All right, so first we're going to calculate the real interest rate. So we just learned the definition of the real interest rate. It's simply discounting the nominal interest rate by the inflation rate. All right, step 2, we're going to calculate how much we will need to save by age 65, and we're going to use our annuity formula to calculate that amount. Third, we're going to calculate the present value of the money we need at age 65. Step 4, we're going to calculate the present value of your salary until then. And then number 5, we're going to calculate the fraction of the 2, which is going to be the percentage of our income that we actually need to save. All right, so let's go through each step. So step 1, calculate the real interest rate. Step 1, calculate the real interest rate. So recall that I defined the nominal interest rate as 7.1% and the inflation rate equal to 2%. And so based on the formula that I defined in the previous slide, our real interest rate is 1 plus R divided by 1 plus I minus 1, which is equal to 1.071 divided by 1.02 minus 1, and this is going to give us 5%. And what you should realize is this 5% is lower than 7.1%, right, which is our nominal interest rate. So that means that inflation is in fact eating away at our opportunity cost. Step 2, we're going to calculate how much you need to have saved by age 65. Since we are planning to spend every year during retirement in constant in real terms, we can use the 25 annuity formula with the real interest rate. Okay, so thus we're just applying the annuity formula but using the real interest rate and our $50,000 payments from age 65 until age 90. So there's 25 years between age 65 and age 90. So that's what we're going to fill in the parameters of our annuity formula. So recall our annuity formula. Suppose we're at age 65. So I'm going to write 65 in the subscript for the present value. And in the superscript, I'm going to write real to indicate that we are using the real interest rate to discount our we're going to discount the real $50,000 with the real interest rate. So $50,000, and we're using 5%, and then the rest of our annuity formula for 25 periods. That's going to give us 704697. So you can double check this yourself. All right, so that's the present value of our retirement plan at age 65. Of course, we can convert this real dollars into nominal dollars simply by adjusting it with inflation. That means growing from the inflation of prices as we age from age 30 all the way to age 65. So the present value, age 65, in nominal terms, can be calculated by multiplying the present value of our retirement package at age 65 and growing it by the inflation rate over from age 30 all the way to age 65. So that's 35 years, which gives us 704697 times 1.0235, and that's going to give us 1,409,317. So the reason I'm writing out two representations of the present value of our retirement package is because we can actually derive each of these. We can derive the present value all the way to time 0, or our age 30, by discounting by the real interest rate or by the nominal interest rate, okay, as I will show you in step 3. Okay, so step 3, we're going to calculate the present value, which is now, or age 30, just to emphasize the timeline of the money you need at age 65. We can do this in two ways. As I mentioned before, we can take the present value of our retirement package at age 65 in real terms and discounting it using the real interest rate. So let's do that. So I'm going to write PV30 to indicate that we are 30 years old, or at time 0, is equal to the present value of the real, in real terms, at age 65 divided by 1 plus RR, or the real interest rate, for 35 periods, right? So we compounded 35 periods because there's 35 periods between age 30 all the way to age 65. And we should get the following. Which is 127,755. Okay? Alternatively, we can also calculate this value by discounting the present value of the in nominal terms of our retirement package at age 65 by 1 plus R, or the nominal interest rate, compounded 35 times. Okay, so I'm just going to write those numbers I wrote in the previous slide. 317 divided by 1.071, 35, which is equal to 127,755. Right, so these are the same. All right, so step 4, we're going to now think about the present value of our salary, right? So the present value of our salary is actually just a growing perpetuity, right? We are accumulating our base income of $75,000 a year is going to grow at 3% but we're going to be discounting it at the nominal interest rate of 7.1%. And this is going to be compounded by 35 times, right? So 35 periods. So this is for step 4. We're going to calculate the present value of your salary until retire. And that's just the present value of our salary. So I'm going to write that in parentheses next to the salary. So present value all the way to age 30, and that's equal to $75,000 every period. And we have a nominal interest rate is 7.1%, but a growth rate of 0.03 or 3%. Multiply by 1 minus 1.030 divided by 1.071, 35 periods. And that's going to give us 1,362,664. Okay, $1,362,664. All right, so finally, we're going to calculate how much of the fraction of our income we're going to save every period so that we can afford this retirement package we defined in the few slides ago. Okay, so that's quite simple. All we need to do is simply divide our present value of our retirement package by our present value of income. So step 5, we're going to calculate the fraction of your income that you need to save. So at time 0 or at time 30, you need to save a fraction x, let's call it x, of 1,362,664 so that you have enough to afford $127,755, which is what our retirement package costs. All right, and we can derive this by writing 1,362,664x equal to 127,755, and then solving for x, which gives us 9.38%. So in short, you save 9.38% of your salary every year, and then you will be able to achieve your objective of retirement, right? Which is paying yourself $50K in real terms from age 65 until you pass away at age 90. All right, so that's nominal and real interest rates. So just to briefly summarize, nominal rates are given. They are provided by banks. They are provided by bond prices, and those returns will be eaten away or undermined by, most importantly, inflation risk or changes in the inflation rate. And so when you think about savings, you have to think about the erosion of your purchasing power over time. And given this example, we can actually incorporate this erosion by modeling inflation directly into our present value calculations. So it's very, very straightforward, actually. You just need to make some assumptions of how inflation rate on average will be over a period of time, or you can actually define its path over time. Okay, so that's nominal and real interest rates. The next topic of discussion is interest rate risk. In this class so far, we haven't really discussed or defined what risk actually is. So at this point in this course, I'm going to give you a more or less simplified definition of what risk really is. So something is inherently risky if it is basically correlated or associated with something that changes over time. So as you can imagine, you can think of there are only precisely a few sources of risk in this world, and if you have a portfolio or an asset that's correlated with these sources of risk, then your asset or portfolio then becomes risky. And so in this lecture, we're going to talk about a specific source of risk, namely interest rate risk, and how changes in interest rates can have an impact on bond prices. Okay, so that's what we're going to do. We're going to try to come up with an expression for evaluating how bond prices changes with respect to changes in the interest rates or the term structure. So we begin with an example. Okay, so first, in example 3, I ask you what is the percent change in the price of a 30-year zero coupon bond when interest rates rise from 4% to 5%. So in this setup, we're going to assume that we have a bond that has a par value of $100, and you will receive that $100 at the end of 30 years. Okay, and then we're just the only variable that we're adjusting or switching is interest rates. So we're going to change from 4% to 5% and then compare the change in prices when that happens. So how do we calculate the price of a bond that pays $100 30 years in the future with interest rates at 4%? We simply do this by discounting this future value back to time 0 with using the discount rate of 4% to get the present value or the price. So the price, so I'm going to write P0 or P0, meaning the price today is equal to $100 in the future, discounted at 1 plus 4%, and it's going to be compounded 30 times, right? 30 years. We're presuming that these interest rates are per annum. If you do this by hand or through calculator, you'll see that the price of this particular bond with a discount rate of 4% is going to give us $30.83. Okay, so that means that in 30 years, that pays a bond that matures in 30 years and pays you $100 30 years later, you should be only willing to pay $30.83 today. All right. Let's now adjust the interest rates from 4% to 5%. So when we switch from 4% to 5%, all we're doing is adjusting the denominator, right? So the denominator is increasing by 1%, or the discount rate is increasing by 1%. So I'm going to write P0 prime to indicate that some particular input has changed. So P0 prime is equal to $100. That's going to be paid to you 30 years later, but it's going to be discounted by 1 plus 5%, which is compounded 30 times. Okay, and that should give us obviously a lower price because the denominator is now larger, and you should arrive at a price of $23.14. So now let's go ahead and calculate the change in P, or the percent change in P, given this change in interest rates by 1 percentage point. So I'm going to write percent delta P to indicate that we're calculating the percent change in price, and that's simply equal to the post price, $23.14, minus the pre-price of $30.83 divided by the pre-price of $30.83. And this should give us a negative decline of 24.9%. Okay, so what we just done in this first bullet point is we took a change, a 1 percentage point change in interest rates to come up with the sensitivity of the bond price reaction, right? And we calculated by hand that the bond price has decreased by 24.9% in response to a 1 percentage point increase in interest rates. Okay, so now we're going to do the same exercise, but now for a shorter maturity bond. Okay, we're going to evaluate the percentage change in the price of a 10-year zero coupon bond for the same change in interest rate. So similarly, the only real difference is now we're no longer compounding by 30 years, we're simply compounding by 10 years, or 10 times. So P naught is equal to 100 divided by 1 plus 4%, compounded 10 times, and you should get a number of around 67.55 cents. When we increase the interest rate by 1 percentage point, we should get P naught prime equal to 100 divided by 1 plus 5%, compounded 10 times, equal to 61.39. All right, so the price levels obviously is going to be higher because it's a shorter maturity bond. There's less discounting, fewer discounting, right? Because the denominator is comparatively smaller than the 30-year compounding, right? So that's not that interesting. What's interesting is that the price change, however, is going to be different. So if we calculate the percent change in price, or the percent delta P, so let me write out the expression of this here. So $61.39 minus 67.55 divided by 67.55. That's going to give us negative 9%. All right, so what you should notice from these two calculations is that it seems that the 10-year zero coupon bond is less sensitive to interest rate changes than the 30-year bond, right? Or said in another way, the 30-year zero coupon bond changes more, given the same exact change in interest rate across in both cases of 10-year zero coupon bond and 30-year zero coupon bond. The intuition is the following. All right, so if we have an increase in interest rates, bonds that have longer maturity contracts will essentially receive your principal payment slower on average. That's the intuition. So therefore, because your money is significantly reduced time in receiving your payments because interest rates has increased, the 30-year bond is much more exposed to changes in interest rate risk than a 10-year zero coupon bond. Okay, so as you can imagine, once you throw in coupon payments, you can actually expedite the speed at which you receive your principal payment, and therefore zero coupon bearing bonds will therefore be less sensitive to interest rate risk, as I will demonstrate in the next slide. All right, so the question you should be asking yourself is, how can we actually structure debt contracts so that we can reduce exposure to interest rate risk, but at the same time maintaining maturity, right? Maintaining the same maturity. Or in other words, how can we make the cash flow arrive faster? So I kind of mentioned this already. We can obviously mitigate interest rate risk by introducing intermediate payments through coupon payments, right? And so that's what we're going to kind of demonstrate now, that by introducing coupon payments, we can make debt contracts or bonds less sensitive to interest rates changes. So let me summarize briefly with text. So the pattern here is that the 30-year zero coupon bond changes more. The intuition is the following. If we increase interest rates, longer maturity contracts receive cash flow payments slower. So I'm going to use quotations around slower, right? On average. Slower compared to shorter maturity contracts, all right? Okay, so let's evaluate a situation in which we have coupon payments and compare that with a zero coupon bond. So in example 4, we're going to think about what the try to quantify what the percent change in the price of a 15-year bond with a 10% annual coupon payment rate with interest rates that rise from 4% to 5%. So the change in interest rates is still the same, it's 1 percentage point, but we're going to try to calculate the price change in this coupon-bearing 15-year bond. And we can do this simply by using the annuity formulas that we learned in week 1 or 2. Okay, so let's just go ahead and calculate this annuity using the annuity formula, but with interest rates at 4% first. So again, similarly, let's use P naught to indicate our initial price under the interest rate of 4%. And as you know, if it's 10% annual coupon payments, we can just use the annuity formula. So let's just write, so we're going to assume that the par value of the bond is still $100. So assume par or face value of the bond is $100. And so 10% of 100 is $10. So we assume that there's going to be $10 payments every year up until the last year. So let's calculate the annuity part of these annual coupon payments of $10. So that's 10 divided by 4% interest rate times 1 minus 1 over 1 plus 4% to the 14th power, right? And then plus the final bullet payment of $100 par value, or the face value, plus the final coupon payment. So that's 110 divided by 1 plus 4%. And this is the last period of 15 years, right? So that's the final bullet payment. That's going to give us $166.70. All right, so now let's do the same thing with interest rate of 5%. So P naught prime, that's going to equal 10 divided by 5% times 1 minus 1 divided by 1 plus 5% to the 14th power plus 110 divided by 1 plus 5% to the 15th power. That's going to give us $151.91. And let's calculate percent delta P, or percent change in bond price. That's going to equal negative 8.8%. All right, so compare this number here with the 10-year bond that we calculated, right? The percent change in the 10-year zero coupon bond with respect to a 1 percentage point increase in interest rates is negative 9%. However, a longer maturity bond, interestingly, with intermediate coupon payments has a lower sensitivity to the same change in interest rates, right? The same 4% to 5%. The percent change in bond price for a 15-year coupon-bearing bond is only negative 8.8%, okay? So, how does this relate to your answer to the previous example? We find that the 15-year coupon bond is less sensitive to the 10-year zero coupon bond. And so maturity is not the right way to measure the sensitivity of the bond prices. So actually, we need a way to measure the speed at which one receives the cash flow emissions or payments of the asset, right? That's the best way to measure sensitivity of bond prices to interest rate risk. Okay, so to answer how does this relate to the answer of the previous example, it's related because the 15-year coupon bond is less sensitive to interest rate than 10-year zero coupon bond. All right, and answering the last question, maturity is maturity the right way to measure the sensitivity of the bond prices to interest rates? No. Right? This is obvious because it's a longer maturity than the 10-year bond, yet because it is coupon bearing, it's actually less sensitive to changes. It's less sensitive to interest rates than the 10-year zero coupon bond. All right, so we're gonna be now introduced to a accurate measure of interest rate sensitivity for bonds using the Macaulay duration definition. Okay, so what I'm going to do is introduce to you the definition first, and then I'm going to derive it for you using some basic calculus. Okay, so the duration is going to be our measure of how fast the cash flows are going to be received for a given bond. Okay, so let me go over each component of the definition of Macaulay duration, or just bond duration. So bond duration is going to be defined in the following way. It's simply the present value of each cash flow period divided by the price of the asset or bond multiplied or weighted by the time period. Okay, so as you can see, in a particular bond that has, a coupon payment 1 year and coupon payment second year, that's more or less represented by C1 and C2. So taking the present value of C1 and C2 is basically calculating the price of just that single coupon payment 1 year from today or 2 years from today. Okay, so you can think of this PV of C1 as the price of the coupon payments, or the precisely present value of the coupon payments 1 year from now, or 2 years from now, or capital T from years until to now. Okay, and we're scaling each of these present value coupon payments by the price. See the denominator. All right, but what's interesting about this definition is that we're actually using these ratio as weights for the time, right? 1 year, 2 year, all the way up to the maturity year. So once you sum up all these components, we arrive at the following expression here. And this expression encapsulates the speed at which one receives the cash flows emitted from bonds. Okay, so this is a central concept in bond market math. All right. So in the last bullet point, we give ourselves a more straightforward definition, right? So duration is basically the value weighted average of the maturity of the cash flows. So let me write out perhaps a formula that gives it more intuition. So you can think of those ratios of the present value of each of those coupon payments divided by the price of the bond as a weight, right? So think of W1 as that ratio, and then we multiply that weight by the time, right? The maturity of a particular cash flow. And we simply sum each of those time or maturity by that weight, right? The present value ratio of the coupon payment to the relative to the price of the bond. Right, all the way until maturity. Okay, this again captures the speed at which an investor receives the cash of a bond security. Okay, so let's go over an example of computing this duration. So consider a 2-year 3% annual coupon bond with a face value of $100, and suppose the yield curve is flat at 4%. So that just means that the nominal interest rate is 4%. What is the duration of this bond? So let's write out a timeline to clarify what this question is asking. So this is only a 2-year bond. So let's start with time 0 and then write out 1 and 2. Okay, and so we have a face value of $100. So with 3% annual coupons, that means the bond will pay $3 every year, okay, until the end of 2 years. So at time 0, we get nothing. At the end of time 1, we get $3. And at the end of 2 years, we get our face value back plus $3. So we will get $103 at the end of 2 years. All right, so based on the formula we saw in the previous slide, there's basically 3 things we need to calculate. We need to calculate, or we think three things we need to know. One is the present value of each of the cash payments each period. And we also need to know the price of the bond. And we also need to know the maturity of each of those cash payments every period, right? 1 year and 2 years. So let's start out with the price of the bond. So the price of the bond is simple to calculate. It's simply the present value of the cash flow payment using the yield curve or the term structure, which is flat at 4%. So the price of the bond is P equals 3 divided by 1.04. That's the year 1 cash flow payment plus 103 divided by 1.04 squared. That's the second year cash flow payments. So that's going to give us a price of $98.11. All right, so now we have to calculate that ratio, right? The ratio of each period's cash flow emission or payment divided by the price. So the first period ratio is 2.88, right? As I already computed out for you, divided by 98.11. You can think of this as the proportion of the bond price that's paid out in the first year. That's going to give us 2.94%, which has a maturity of 1, right? Because it's going to pay out 1 year from now. The other fraction or the ratio is the proportion, the rest of the bond price that's going to be paid out in the future at the end of 2 years. So that's going to be this number here. So that's 95.23 divided by 98.11. That's going to give us a number of 97.06%, and that has a maturity of 2. All right, so we computed the price, we computed the present value of each of those cash payments each period, and then we took the ratio, and now we simply have to weight each of those maturity years with those ratios. So the duration is equal to 2.94% times 1 plus 97.06% times 2. And that's going to give us 1.97. All right, so that is how we calculate duration for a bond that has annual coupon rates. And the calculation is straightforward because everything falls into very neat little buckets of annual payments, right? Things get a little bit complicated when you have semi-annual payments. Don't worry about that. I won't ever ask you complicated questions on an exam, okay? And typically we have software that does this for us. Okay, so I'm going to explain to you mathematically why this duration measure actually measures the sensitivity of bond prices with respect to interest rates. Okay, derivation requires some calculus, so let's just write out the pricing formula for bonds first, and then we're simply going to take the first derivative of the bond price with respect to interest rates. And once we do some algebra, you'll realize that doing this will actually give us precisely the duration expression that we saw a few slides ago. So let's start out with the bond price formula, which is simply the NPV formula, right? The bond price, let's call it P, is equal to each period's cash flow payment. So let's suppose this cash flow payment is annual to make things easier. So cash flow payment is C, and let's generalize it to T periods. So let's go all the way to final payment in which we receive our par value. So I'm going to use F to designate face value plus the final coupon payment. Okay, and it's all going to be discounted by a fixed interest rate, and we're going to call that R. So for the first year, we discount by 1 plus R. The second year, we discount by 1 plus R squared. Third year, 1 plus R cubed. And the final payment is 1 plus R to the T power, right? Next, we're going to take the derivative of P with respect to R. Okay, so in calculus, dP dr just means that I'm going to change R by a very small amount, like very, very small amount, infinitesimally small, and see how P changes with respect to that infinitesimal change in interest rates. So that's going to equal negative C divided by 1 plus R squared plus 2C 1 plus R cubed. I'm going to go out a little bit further here. 3C plus divided by 1 plus R fourth all the way to T times F plus C divided by 1 plus R T plus 1. Okay? Now let's factor out 1 divided by 1 plus R and negative 1. So factor out negative 1 and 1 divided by 1 plus R. So let's move this here. That's going to give us negative 1 plus R. And then you'll realize that we will have arrived at a duration expression. We will get C divided by 1 plus R, plus 2C 1 plus R squared plus 3C 1 plus R cubed plus all the way to T F plus C divided by 1 plus R to the Tth power. Now let's multiply both sides of the expression by 1 over P, right? And also let's multiply by 1 over P here. Okay, so you can distribute the 1 over P into the sum, right? And then that will basically give you the ratio, the present value of the payments, cash flow payments, divided by the price, right? That gives you the duration measure. And at the end, we realize that 1 over P times dP over dr is actually equal to minus duration divided by 1 plus r, right? That's what we ended with, right? This is the precise expression that's given here. Or to be more precise, this is saying dP over P is equal to negative d divided by 1 plus r times dr, right? The dr is the change in r. This term here is the same here. Percent change in price is this term here, okay? So what we did is showed that duration is basically directly related to the sensitivity of bond prices to changes in interest rates. Okay? All right, so we will conclude our discussion on duration with a brief historical discussion on mortgage lending during the 1980s. And if you've studied financial history before, you'll know that there was an economic collapse in the mid to late 1980s, which was related to duration mismatch. Okay, so duration mismatch just means that your cash flow payments do not offset each other. In fact, the example here, or the case in which we had significant duration mismatch, occurred in the mortgage lending market because the lending rate started to fall below the borrowing rate. And so banks and other financial institutions weren't able to, generate money, right? Banks and other financial institutions make money by lending out money at a high interest rate and borrowing money at a low interest rate, okay? But things start to go wrong once your lending rate falls below your borrowing rate, okay? In the US, the mortgage lending business used to be called a 363 business because banks and other financial institutions typically borrowed at 3% and lent money out at 6% and then played golf at 3 p.m. Okay, so the 363 is in reference to that typical practice. But what happened during the mid and late 1980s was that there was rampant inflation. And what the Fed did in response to inflation, the Federal Reserve, or the Central Bank of the US, is that they increased interest rates from 9.5% to 12%. So there was massive interest rate risk. So let me write that down to give you some context. To reduce inflation, the Fed, or the US Central Bank, increased interest rates from 9.5% to 12%. And this is, a massive source of interest rate risk. So what happened is that the Federal Savings and Loan Insurance Company had long-term loans at fixed interest rates, but those loans turned out to be lower than the borrowing rate. So they ran out of capital and couldn't generate enough money to pay off their liabilities. So the Federal Savings and Loan Insurance Company had long-term loans at fixed interest rates. Okay, you can imagine they are receiving payments at 6%. Okay, but now after the Fed increased interest rates to 12%, they could only borrow money at a 12% interest rate. So definitely they cannot generate sufficient amount of money from their long-term loans to pay off those higher borrowing rates. So these fixed interest rate loans were lower than the borrowing rates. And what happened is that they ran out of capital. They couldn't generate enough to pay off liabilities. Okay, and so what happened is that we had, we had DP over DR, right? And it became, massive, right? As we increased interest rates, the price of bonds will deflate, right? And so the value of these loans mechanically have to drop. Sorry, it should be the other way around. Right, so increases in interest rates will decrease the value of those loans, and because, again, from the duration perspective, the higher the interest rates, the longer it takes for those cash to be received. All right, so that's our discussion on duration, bond duration, and duration mismatch. So the final topic that we want to discuss for this course is on no arbitrage pricing. Okay, so this is basically related to the construction of the term structure when the zero coupon bonds aren't actually being traded in reality, right? So to remind you again, the term structure of interest rates actually represents the zero coupon interest payment for maturities along, the x-axis. However, zero coupon bonds in general aren't traded on open markets, and so what we have instead is coupon-bearing securities, right? U.S. Treasuries that pay coupon payments semi-annually. Of course, there are very short-term Treasury T-bills that have no coupon payments, but in order to actually construct a term structure, the precise way to derive a zero coupon bond yield is through a construction of a portfolio of coupon-bearing securities such that those coupons actually cancel out. And so, in general, we synthetically generated a zero coupon bond, and therefore we can extract a zero coupon bond yield. Okay, so that's the exercise that we want to go through in this final part of today's lecture. Okay, so like I said already, the term structure gives the interest rates for securities, loans that have no intermediate payoffs, right? There's no coupon payments. And so what we're really interested in is trying to figure out a way to use existing bonds that's being traded on the open markets that do have coupon bearing, that do have pay coupons, and somehow derive a synthetic zero coupon bond that allows us to extract these interest rates, right? Okay, so to reiterate, the yields on coupon bonds are not equal to the points on the term structure, right? Because a zero coupon bond, its yield is only computed for one variable, right? One variable for the final payment. But in coupon bearing payments, you have that same variable being the discount rate over several periods. And actually computing that number is quite complicated. All right, so just to emphasize, the zero coupon bond or the term structure interest rate is not the same as the bond yield that pays coupons or intermediate payments. Okay. All right, so let's walk through an example. So suppose we have a yield on a 1 year zero coupon T-bill, and that yield is Y1 is equal to 2%. What is R1? So as I mentioned before, because T-bills pays no intermediate payments, the bond yield is the same as the term structure of interest rate for 1 year. So Y1 is equal to R1, and so R1 is equal to 2%. Y1 is equal to R1, which is equal to 2%. Suppose the price of a 1 year zero coupon T-bill with a face value of $100 is 90. What is R1? So that's quite simple too. Again, we have no coupon payments, so it's just one final bullet payment of $100. Discounted at R1, and we know the price, which is 90. And so R1 is simply equal to 100 divided by 90 minus 1, and that's equal to 10%. Okay? So zero coupon bonds are often called pure discount bonds because you can just use the bond yield directly as the discount rate. Okay. All right, so let's go through an example, another example. We're going to use this information to calculate the term structure of interest rates for 1, 2, and 3 year, and it should be quite simple because they are all zero coupon bonds. So in this example, it states that we retrieve the following information about 3 zero coupon bonds of different maturities, and they all have a face value of $10,000. Okay, so there's 3 zero coupon bonds, A, B, and C, maturing in 1, 2, and 3 years respectively, and they have the following prices listed here. All right, so let's go ahead and use this information. So this price information, this is based on buying and selling of those traders, and based on demand and supply, in which we get a price, we can therefore derive a bond yield, right? And those yields are going to be equal to the term structure interest rates because they are zero coupon bonds. So let's go ahead and calculate those bond yields. So as I mentioned before, the term structure interest rate is going to equal to the bond yield because there's no coupon payments, which is therefore for 1 year, the real interest rate is simply just, the term structure interest rate is simply 10,000 divided by 9,756.1 minus 1, and that's going to give us 2.5% for 1 year. For 2 years, it's going to be equal to the bond yield of this zero coupon bond maturing in 2 years. And that's going to be equal to 10,000 divided by 9407.68 to the 1/2 power minus 1 equal to 3.1%. Okay, the 1/2 comes from the fact that we write out the present value expression, or the bond pricing expression, and we're just solving for the bond yield directly. Okay. Lastly, R3, which is equal to Y3, and that's going to be 10,000 divided by 9045.62 to the 1/3 minus 1. This is going to give you 3.4%. All right, so when we're given zero coupon bonds or zero coupon bonds are traded on the open market and we have bond prices, it's very straightforward to calculate the bond yield, which precisely is the term structure of interest rates. Very simple. But in general, zero coupon securities are not available at every maturity. And so what we're going to do is rely on coupon bonds and the law of one price to synthesize prices for zero coupon bonds. Again, the idea, as I mentioned, is we're trying to create a portfolio of coupon-bearing bonds in which the coupon payments cancel out. So the portfolio in its entirety actually mimics a zero coupon bond. And because of the law of one price, we can actually calculate a price for this portfolio. And this price will therefore represent the price of the zero coupon bond. Using that in mind, it's straightforward, right? We have the price, we have its cash flow payment, which is just a single bullet payment, and we can therefore calculate the bond yield, and that yield turns out to be the term structure of interest rates. So let's go through an example here. So suppose you have two data on two treasuries or U.S. government issued bonds. Bond A has 6-month zero coupon. It's a 6-month zero coupon bond with a face value of $100. So that means this bond expires or matures in 6 months, and you will get a face value of $100 at the end of 6 months. Bond B is a 1-year coupon bond with a face value of $100 and a coupon rate of 10%. So that means that you will receive $10 or 10% of 100 every 6 months, and also receive your final face value payment at the end of 1 year. So what we're going to do is we're going to create a zero coupon bond in the following way. We're going to sell 1/10 of bond A and buy 1 of bond B. Okay, and this will actually be straightforward once you see the table. Okay, so we have bond A that pays $100 at the end of 6 months, and then you have bond B that pays $10 at the end of 6 months and $110 at the end of 1 year. And if we sell 1/10 of bond A, then we only have to pay out 1/10 of 100, right? And so at the end of 6 months, we only have to pay negative 1/10. So 1/10 times 100 is 10, right? Multiplied by a -1 is -1. And we add these together, that's going to give us 0. Do the same thing for 1 year, right? -1/10, that's 0 times 0 is 0, plus 110, and you'll have a cash flow payment of $110 at the end of 1 year. So at the end of the day, we've constructed a portfolio of bond A and bond B that mimics a zero coupon bond. Okay, if we know the price of bond A and bond B, then it's very easy to compute the price of this portfolio and also compute the bond yield of this implied bond yield of this portfolio. Okay, so the key assumption here is that a portfolio of bonds is still a bond. Okay, so in the next slide, we introduce additional information. We assume that bond A has a price of $90 and bond B has a price of $100. Okay, given the same portfolio, we're going to sell 1/10 of bond A and buy 1 of bond B. And so we can have a price of this zero coupon bond portfolio. So the price, so I'm going to write PV of zero coupon bond, ZCB, is equal to 100, right? Because we're buying bond B, so it's worth $100, but then we're going to sell 1/10. So that's going to be a minus 90 divided by 10. So this is buy and this is sell. You can think of this as cost. All right, and that's going to give us a price of $91. Okay, so once we have this $91, we have that final bullet payment at the end of 1 year. Then it's very straightforward to calculate the bond yield, right? 91 is equal to the final bullet payment of $110 discounted at 1 year. Solve for R1. And that gives us roughly 20%. Okay? So let's do something a little bit more complicated. So for example 7, suppose you observe the following prices for different bonds, each with face value of $100, and recall that Treasury notes or T-notes pay semi-annual coupons. So we have 3 bonds, A, B, and C. A and B are both Treasury bills, meaning that there's no coupon payments given that they're short maturities, but they will mature in 6 months and 1 year respectively. And we also have a final bond C, which is a Treasury note. It's coupon bearing, pays 6% of its face value, and it will mature in 18 months. And so our task here is to determine the 6, 12, and 18 months interest rates of the term structure, or the spot rates. All right, so first things first, we already have 0 coupon bonds, the Treasury bills, bond A and bond B. So let's first calculate the spot rates, or the term structure of interest rates for 6 months and 1 year. So that means that R 0.5 is equal to 100 divided by 97.51 squared minus 1, which is equal to 5.2%. Similarly, R1 is equal to 100 divided by 94.56 minus 1 equal to 5.8%. All right, so the hard part is figuring out how to calculate the 18th month interest rate, or the spot rate. So we can do this by, as usual, coming up with a portfolio of bonds A, B, and C, right? So let's write a table here. So let's look at the cash flow payments at the end of 3 periods. So we can look at the cash flow payments at 6 months, 12 months, and 18 months. For bond A, bond B, and bond C. And so the goal here is to make the cash flow, intermediate cash flow payments go away, and at the end have a final bullet payment of 103, right? So let's first look at the timing of the bond payments first. So for bond A, we simply receive the face value at the end of 6 months. That's just $100. For bond B, similarly, it's a 0 coupon bond, so we won't have any intermediate payments. We will just have a final bullet payment of $100 at the end of 12 months. For bond C, however, we have a 6% per annum coupon rate. So we divide that by 2 and multiply that 6% divided by 2 equal to 3%, right? Multiply that by the face value. So we will actually get $3 every 6 months. And a final bullet payment of $100 plus $3. So this $3 comes from 6% divided by 2. Okay, so obviously what we have to do is we're going to have to buy bond C, right? But we want to come up with weights of bond A and B that cancels out the coupon payments. And we can do this by selling 3%, right, of a bond A or bond B, right? We just multiply this by 3 divided by 100 and 3 divided by 100, right? And once we sum them up vertically, we have minus 3 plus 3, which is 0. So just make sure that we're selling 3%. Sell. We will end up with a synthetic portfolio of bonds that has no coupon payments, 6 months and 12 months. But in 18 months, we will have a final payment of 103. So we finally derived a portfolio that mimics a zero coupon bond that pays out at the end of 18 months. Okay? Sorry. So let me write out the portfolio. We're going to buy our portfolio cost actually looks like the following. We're going to have a bond C minus 3 out of 100 times bond A plus bond B. So if you have the price of bond A, bond B, and bond C, you just plug those in and you should get the price of the synthetic zero coupon bond or the portfolio of bonds written here. Okay? All right, so we do have prices, so let's just plug those prices in. So the present value of our zero coupon bond portfolio is equal to the bond price of bond C, right, which is $99.31, I believe. Yes. And we're going to sell 30% of the sum of bond A and bond B, which is 97.51 plus 94.5. And that's going to give us 93.54882-ish. Okay? And so once we have the price, we have the cash flow payments with the final bullet payment of 103, we can simply calculate the bond yield outright, right? So that's R 1.5, so 1.5 meaning 18 months is equal to 93.5482 divided by 103 to the 3's half power minus 1. And that's going to give us 6.6%. So this is our spot rate or the term structure of interest rate maturing in 18 months or 1.5 years. Okay? All right, so this concludes our discussion on additional topics on interest rates. So if you have any questions, please leave a comment below or send me an email. That's it for now. Have a nice day.